Are you leaving cash in the bank earning less than 4%? Come on, that's financial suicide. I mean, not just mentioned from inflation, but you could be doing so much better with infinite banking, and here's why. All right, let's do a side-by-side comparison, right? Because there's always been this debate. People are like, wait a minute, like, why not just keep my money in savings? Why would I put it into this whole life insurance policy? Now, if you don't know what infinite banking is, it's the strategy which utilizes whole life insurance. Now, whole life insurance is not death insurance like term insurance. The typical term insurance policy you hear about is just death insurance. Whole life insurance does have a death benefit, but it also has a tax-free savings account inside of it. Now the crazy thing is, here in the United States, we don't have a tax-free savings account. We have savings accounts that get taxed, right? So not only do you earn pretty low percentage in your savings accounts, but you also get taxed on that percentage too. Where inside the whole life policy, you put it in there, it grows tax-free, comes out tax-free. It's kind of like a Roth IRA, but you can actually access it now like a savings account. And as I teach a lot of our clients, you can even use it to invest to make money in two places at the same time. But that's another video that you can also subscribe to our channel to follow to find more on. Now, let's talk about this side by side, because many people say, hey, these things are expensive. You hear Dave Ramsey rip on them all the time. These things are expensive. They're a waste of money. Just buy term, invest the difference, you know? And I want to show you here, if you're going to keep money in savings, can you do it better? Because I know I can keep my money in the bank, and in fact, I do. I have money in a bank, I have money in a high yield savings account, but I keep the lion's share, the vast majority of my money inside my life insurance, and I'm going to show you why right here. Okay, so let's start with the traditional savings account, right? We go in this calculator here. I'm going to show you that if you're just paying in $10,000 a year for the next 17 years, and by the way, I only did this because I have a real life client example of a 45-year-old that's doing the same thing. And so this $10,000 a year you're putting in. Now understand you do earn interest. I put this at 3% because I know that where rates have been higher, they've been coming down. Most people aren't even getting 3%. I know some might even be getting 3.5% right now. 4 is like pushing it, unless you're doing CDs. But CDs is a little bit different. You're locking your money up. It's not the same kind of comparison as what we're seeing here. So we're looking at a savings account at 3%. Now remember, you get taxed on that money each year. Now at the end of this, you will see that you have a total of $209,000. You've paid in $170,000, but after you've paid taxes at a 24% tax bracket, you've lost about $12,000 to tax, so you're now left with about $39,000 extra, which is why you have $209,000 after 17 years. Now, is this horrible? Of course not. It's better than nothing, but you're definitely not getting rich off of this, are you? You're not making a crap load of money here. So that's that one. Now, what would that look like with a life insurance policy? Now, understand with whole life insurance, something you're going to see here before we show this is that every whole life policy has front-loaded costs. So where term insurance gets more expensive over time, whole life insurance starts out more expensive and gets cheaper, at least with the insurance costs coming out. Now, the way I'm showing you here, this is not a traditional whole life policy. If you try to go to your State Farm agent, they'll say, oh yeah, it won't look even close to that. You'll pay way, way, way more in fees, really unnecessary fees. That's because, one, agents don't know how to do it, and or two, even if they did know how to do it, they refuse to do it because it cuts their commissions by about 80%. And so they don't want to do it. And so what I'm showing you here is a real life example of one of our clients where I said, hey, if you're going to put in $10,000 a year, this is what it looks like. Now, he's not required to put in $10,000. He has flexibility here. But of course, there are upfront costs. Those first 2 years are the most expensive with whole life. So as you see here with this particular client, that first year you put in $10,000, you've got just over $8,000. And yes, this money is accessible even from day one. Despite some people's whole life policies where they have to wait years to get to it, you don't have to with ours. Now, $8,000. Now you might say, wait a minute, I lost 20% or 19% in this case. And you might put it that way, yes. Now, notice I'm not saying buy term, invest the difference, or save the difference. If I would have said buy term insurance and then save the rest, we might have more of an apples-to-apples discussion. It would be way better. I'm playing devil's advocate against my own point, because even if you don't have a term insurance policy, which in this case we do have a death benefit, but here, watch what will happen. Now, yeah, the first year, you'll see in the first year with the savings account, you got $10,227 after you paid taxes. Well, that definitely beats over $8,000. Even the second year in that savings account, you have $20,686, and you're looking at this saying, well, geez, I've got almost $17,000. So now I've got like $3,700 less. But this is the cool thing. If you see that third column from the right, it tells you what's the net cost or gain of this policy. Remember, this policy is growing tax-free. By that third year, you see there's a $133 net gain above what you paid into it. Well, what does that mean? That means now the interest you're earning inside that policy, which right now they're paying right around 6% tax-free currently, that interest is now offsetting even the insurance costs. And that's why the next year you see it go up to like $890 and then $1,700, right? So it starts catching up. So yeah, by that 5th year, you'll see you have about as much as what you paid in. So you're thinking, okay, by 5 years in, I've made about a 0% return on this tax-free savings account. Now granted, you have a death benefit, right? You do have life insurance that's over $250,000 that you have, but you've just paid $50,000 in to have roughly about $50,000. See, this is what people will really fixate on, right? They'll fixate on this thing. Look at how expensive it is. It's a ripoff. And yeah, if you're looking short term, only at that, yes, it is going to be less than what you have in savings. Because yeah, you flip over here to the savings side, you got $53,500. You're like, well, I still got, again, still roughly about $3,500 more. Now notice that the spread stopped. It's not getting bigger anymore. It's actually starting to shrink at this point because now it's earning more in interest than the other side. On this other side, remember, you earned about $1,500 in interest, but you had to pay $375 in tax. So you only made $1,200 in interest. Where on the life insurance side in year 5, you netted $1,700. And then it just keeps going from there, right? So by 10 years, now you have almost $118,000 in the life insurance, where in the other side, you have $113,000. So after 10 years, now the whole life has actually beat your savings account. It is now outperformed your 3% savings account because you're paying tax there, where again, this is tax-free. You don't have to file this with your tax returns. Oh, and by the way, this is the one place you can keep your money safe, because not only is it guaranteed to always pay interest, but in most states in the United States, you are 100% guaranteed to not lose money to lawsuits and creditors. That means you can have millions of dollars stored here, and if somebody sues you and wins, they can't get to it. Where in your savings account, they can drain it all. If they sue you and win, your savings account is gone. So this is one of the best places to protect it, and it's tax-free, and of course, you're now earning a better return. Notice after 17 years, like I said, we had $209,000 in the savings account, but on the life insurance side, the whole life insurance side, we've got almost $251,000 at this point. Now it's earning over $11,000, almost $12,000 a year, tax-free, net of insurance costs. Net of insurance costs. Yet while on the other side, that 17 years, we were looking at $6,000 minus the $1,400. So you're like, oh yay, like I maybe made $5,000, right? That's about it. I made $5,000 while the other side was making like more than double that. That's the difference. It might start out slow. I think of it like if I'm on the freeway and I see cars pass me on the left, I might brake a little bit in that right-hand lane to give some buffer between me and the other car. So then as they start to pass, then I can go and speed up and get in the other lane. Yeah, I went slower, but as I was able to change to a better lane, I was able to go faster eventually and pass those other cars. Same thing here with savings. You can pass the other savings, what you could do by having an infinite banking policy. And the cool thing is here, yes, you can use this for whatever you want. You can invest it in your business and still get tax breaks. You can invest in real estate and make passive income off of it, which is what we teach our people to do rather than locking up in 401ks. So there's so many utilities, so many ways you can utilize this for your advantage because of this. So as you can see, infinite banking is the clear winner, especially as time goes on. And this is why so many wealthy people use it. If you want to figure out how to use it in your situation as well, go to moneyripples.com/infinite-banking or click on this link below today.